let's take a look at the last question on the Chapter 18 quiz. So Vanseda Corporation uses the completed contract method for tax purposes and the percentage of completion method for accounting purposes. Assume that on July 15, 2020, a new income tax rate is enacted that lowers the corporate rate from 30% to 28%, effective January 1st, 2022. Vansada Construction Inc. has one temporary difference at the beginning of 2020 related to a $1 million tax deferral from using the completed contract method. Vansada therefore had a deferred tax liability account at January 1st, 2020 with a balance of $300,000, which is $1 million times 30%. The $1 million in gross profit recognized to date is expected to be taxed in 2023. And we're asked to calculate the deferred tax liability at July 15, 2020, after taking into account the change in tax rates and prepare the related journal entry at that date. So as soon as there's a change in tax rates, we recognize it immediately for anything that's we know we've accrued to happen in the future. So let's set up a schedule here to figure out what our entry needs to be. Future taxable amounts. And I'm going to put the year across the top. So I'm going to have 2021, 2022, 2023. And the reason I'm going out that far is because it says it's expected to be taxed in 2023. And I'm also going to run a total. So there's nothing happening in 2021 or 2022, but in 2023, we're told that we're going to have this $1 million taxed. Okay. So what we need to do here is put the tax rates, new. So the tax rate here was 30%, and it's expected to change to 28% effective January 1st, 2022. So here I'm going to change it to 28, and of course here it's going to be 28. So my deferred tax liability is going to be the amount, the taxable amount times the tax rate. So here I've got 30%, but of course it's 0, so it's going to be 0. Going to drag that across, and I can see that the $1 million taxed at 28% gives me $280,000, which makes sense, of course. So my total here, let's just run a sum because of course my deferred tax liability is across all years. So this is still going to be the 280 just because there's 0 in the other years. So would I record my journal entry then for 280? No, I wouldn't, because don't forget right here, it says we already have a deferred tax liability at January 1st, 2020 with a balance of $300,000 because the tax rate was 30% and it just changed to 28%. So basically I need to calculate my opening deferred tax liability. Remember that this account is the change, and here I already had 300,000. Whoops, not 3 million, 300,000. So my change in the deferred tax liability is going to be the 280 minus, or the 300, I should say, minus the 280. So now I've got a $20,000 reduction, and this is a reduction in my future liability because of the fact that the tax rates went down. So I thought I would have a future liability at 30%, but good news, I only have a future liability now at 28%. So the entry I need is actually to reduce my future liability by the 20% benefit that I received by the tax rate decreasing by the future tax rate decreasing by 2%. So I'm going to debit my deferred tax liability, which is reducing it, of course, because this is a liability, and this is statement of financial position account. So that's going to be my 20K. And my credit is going to be deferred tax benefit on the P&L. So this is basically going to reduce my tax expense now, my future tax expense, my deferred tax expense by 20,000. And that is the entry. So the key is remembering we're always looking at the change in tax rates, not just the impact of the tax rate itself. That would only be the case if this was a new difference and we needed to put it on the books from scratch. B says, discuss the impact of the Discuss if the impact of the change in rates is required to be disclosed or not under IFRS or ASPE. So not surprisingly, ASPE does not require the impact of a change in tax rates. Required disclosure, I should say, required disclosure of the impact of a change in tax rates, but IFRS does. And that's not surprisingly because generally speaking, IFRS requires more disclosure than ASPE. And that takes us through the last question.